Stay informed about global economic and geopolitical developments, as they can influence market movements. Bitcoin mining is a crucial process in the Bitcoin network, essential for the creation of new Bitcoins and the maintenance of the blockchain ledger. At its core, mining involves solving complex cryptographic puzzles, which require significant computational power. Miners, individuals or entities running these powerful computers, compete to solve these puzzles, and the first to do so adds a new block of transactions to the blockchain. This process not only verifies and records transactions but also introduces new bitcoins into circulation as a reward for the miner's efforts. The mining process begins with the gathering of pending transactions into a block. Miners then use their computational resources to solve a mathematical problem that involves finding a hash, a fixed-length alphanumeric string, below a certain target threshold. This problem is known as proof of work. The difficulty of this problem adjusts approximately every 2 weeks to ensure that new blocks are added to the blockchain roughly every 10 minutes. This self-adjusting mechanism maintains the consistent and predictable issuance of new bitcoins. As miners race to solve the puzzle, they consume substantial amounts of electricity and generate significant heat. This has led to concerns about the environmental impact of Bitcoin mining. Mining operations are often concentrated in regions with low energy costs, such as China, which until recently dominated the industry, and more recently, places like Texas and Kazakhstan. Renewable energy sources are increasingly being used to mitigate the environmental footprint, with some mining operations investing in solar, wind, and hydroelectric power. The economic incentives for mining are twofold: the block reward and transaction fees. When a miner successfully adds a block to the blockchain, they receive a block reward, which currently stands at 6.25 bitcoins but is halved approximately every 4 years in an event known as the halving. Additionally, miners collect fees from the transactions included in the block. These rewards incentivize miners to continue validating transactions and securing the network. Despite its decentralized nature, Bitcoin mining has seen significant centralization due to the rise of mining pools. These pools allow individual miners to combine their computational power, increasing their chances of solving the cryptographic puzzle and earning rewards. The rewards are then distributed among pool members based on the amount of computational power contributed. While mining pools make it easier for smaller miners to participate, they also concentrate mining power, raising concerns about the potential for a 51% attack, where a single entity controls the majority of the network's hash rate. In conclusion, Bitcoin mining is a vital but resource-intensive process that underpins the security and functionality of the Bitcoin network. It balances economic incentives with computational challenges, ensuring the integrity of the blockchain while continuously introducing new Bitcoins into the ecosystem. However, the environmental impact and increasing centralization pose ongoing challenges that the community continues to address. Our expert advisor is active. Bitcoin mining is a global activity, with certain countries emerging as significant players due to favorable conditions such as low electricity costs, supportive regulatory environments, and access to technological infrastructure. These factors collectively determine where mining operations are most viable and profitable. China historically dominated the Bitcoin mining landscape, accounting for a substantial portion of the global hash rate. This dominance was largely driven by the availability of cheap electricity, especially from coal and hydroelectric power plants in regions like Sichuan and Xinjiang. However, in mid-2021, the Chinese government imposed a sweeping ban on cryptocurrency mining and trading, leading to a dramatic reduction in China's share of the global hash rate. This regulatory crackdown forced miners to relocate their operations to other countries. Following the exodus from China, the United States emerged as a major hub for Bitcoin mining. States like Texas, Wyoming, and New York have become attractive destinations due to their favorable regulatory climates, access to cheap and renewable energy, and established technological infrastructure. Texas, in particular, offers abundant wind power and deregulated electricity markets, which have drawn significant investment from mining companies. Additionally, the political support for cryptocurrencies in certain states has further bolstered the U.S. position as a leading Bitcoin mining nation. Kazakhstan has also seen a significant influx of mining activity post-China's ban. The country offers relatively low electricity costs, largely derived from coal power, and a generally supportive regulatory environment. However, the rapid growth of mining in Kazakhstan has strained its energy grid, leading to occasional blackouts and prompting the government to reconsider its energy policies. Despite these challenges, Kazakhstan remains a key player in the global Bitcoin mining industry. Other countries with notable Bitcoin mining activities include Russia, Canada, and Iceland. Russia benefits from vast natural resources and a cold climate, which helps reduce cooling costs for mining equipment. Canada offers access to hydroelectric power, especially in provinces like Quebec and British Columbia, making it an attractive location for environmentally conscious mining operations. Iceland, with its abundant geothermal energy and cool climate, also provides an ideal environment for sustainable mining practices. In recent years, there has been a growing emphasis on the environmental impact of Bitcoin mining, leading some countries to leverage renewable energy sources for mining operations. Countries like Norway and Sweden, with their ample hydroelectric and wind power resources, have become increasingly significant in this context. These nations not only offer sustainable energy but also align with the global push towards reducing the carbon footprint of Bitcoin mining. In conclusion, Bitcoin mining is a geographically dispersed activity influenced by a complex interplay of economic, environmental, and regulatory factors. While the landscape has shifted significantly, particularly with China's exit, new leaders like the United States, Kazakhstan, and several other countries have stepped up to fill the void. The evolving nature of mining regulations and energy policies will continue to shape the global distribution of Bitcoin mining activities. Light discussion on various aspects of trading, from risk management to mindset and strategy, that are of great value to everyone, especially new traders. Before elaborating my trading strategy, I would like to advise new traders that their first target, as a crypto trader, should be to save your capital. Once you have mastered saving your capital, then go for earning from crypto trading. And after getting the skill of earning, you should try to become rich or millionaire by crypto trading. But if you directly want to achieve third level, you can never be profitable. The crypto market is very uncertain. There is no strategy that is always 100% profitable. Risk management, proper psychology and control of emotions are the factors behind my strategy. I may be in loss, in a session or in a day, but not in a week or a month. That's how things work in the life of a crypto trader, and that's the beauty of crypto trading. The key points of my trading strategy are: I do semi-automated trading. It's very difficult for a human to control his psychology and emotions during trading in highly volatile market of crypto. That's why I believe software tools are necessary in crypto trading. I use hybrid approach in my trading that involves human input as well as my own developed expert advisor, EA, algorithm to hint for best entries in trendy and sideways market, keeping in view the running fundamentals of the market. My EA doesn't follow the direction of any daily technical analysis, but looks for suitable entries in both directions, sell and buy. The TP, SL and break-even settings are performed by the EA bot. That really makes my work easy. I constantly keep on improving my EA to improve its performance. I trade all sessions. No doubt, there is more trading volume in the market during New York session and during sessions overlapping. However, good opportunities can come anytime. That's why I love to trade all sessions, looking for nice entries. I take multiple positions in same direction. Whenever I found a suitable entry, I run multiple positions of same lot size and same stop loss, but with different take profits. One of these positions will have open TP, in order to take maximum benefit from big market moves. Sometimes my SLs may trigger in a row, but these net SLs are much smaller than my net TPs. That's what makes me profitable. I do break-even of remaining positions after 1 or 2 TP hits. In my trading, when 1 or 2 TPs are hit, I move SLs of all other running positions to break-even level. This may deprive me of taking benefit from my entry, if market retests my entry level and then bounces back in my direction. In this case, I don't take next entry in same direction. I'll wait, and the waiting period sometimes may extend even up to a couple of hours or so, until I found an opportunity in opposite direction. Then I will take my next entry. Bitcoin is working. Trading support and resistance levels is a core strategy in technical analysis, providing traders with critical insights into potential price movements and key decision points. These levels represent psychological barriers where prices tend to pause, reverse, or break through, influenced by the supply and demand dynamics in the market. Support levels are price points where a downtrend is expected to pause due to a concentration of buying interest. At these levels, demand for an asset is strong enough to prevent the price from falling further. Traders look for support levels to identify potential entry points for long positions, anticipating that the price will rebound from these levels. For example, if a stock repeatedly falls to $50 and then rises, $50 becomes a support level. Confirming a support level involves looking for repeated bounces off this price point and analyzing volume patterns, as higher volume at support levels can indicate stronger buying interest. Resistance levels, conversely, are price points where an uptrend is expected to pause or reverse due to a concentration of selling interest. At these levels, the supply of an asset is sufficient to prevent the price from rising further. Traders use resistance levels to identify potential entry points for short positions or to exit long positions, anticipating that the price will drop after hitting these levels. For instance, if a stock repeatedly rises to $100 and then falls, $100 becomes a resistance level. Confirming a resistance level similarly involves observing repeated price rejections and volume patterns, with higher volume at resistance levels suggesting stronger selling pressure. Trading support and resistance involves several key strategies. One common approach is range trading, where traders buy near support levels and sell near resistance levels within a well-defined price range. This strategy works best in markets that lack a clear trend and move sideways. Traders can use indicators like the Relative Strength Index, RSI, or stochastic oscillators to help identify overbought or oversold conditions within the range, enhancing the timing of their trades. Breakout trading is another popular strategy that focuses on prices breaking through established support or resistance levels. A breakout occurs when the price moves decisively above a resistance level or below a support level, often accompanied by increased volume. Traders enter positions in the direction of the breakout, expecting continued movement in that direction. For example, if a stock breaks above a resistance level of $100 with high volume, traders might buy, anticipating further gains. To minimize false breakouts, it's essential to wait for confirmation, such as a closing price above the resistance level or a significant volume spike. Pullback trading involves waiting for the price to break through a support or resistance level and then entering a trade when the price retraces to test the broken level. This strategy aims to capitalize on the price momentum after a breakout has been confirmed. For instance, if the price breaks above a resistance level and then pulls back to test this new support, traders can enter long positions, anticipating that the previous resistance will now act as support. Effective risk management is crucial when trading support and resistance levels. Traders should use stop-loss orders to limit potential losses, placing them just below support levels in long trades or just above resistance levels in short trades. This approach helps protect against significant losses if the market moves against the trade. In summary, trading support and resistance levels involves identifying key price points where the market is likely to reverse or pause and using these levels to inform trading decisions. Strategies such as range trading, breakout trading, and pullback trading can be employed to capitalize on these price movements. By combining these strategies with effective risk management and confirmation techniques, traders can enhance their ability to profit from market fluctuations. The BTC market is going on. Cryptocurrency trading presents a myriad of opportunities, drawing attention from both seasoned investors and newcomers alike. One of the primary opportunities lies in the market's volatility. Cryptocurrencies are known for their significant price fluctuations, which can occur within short time frames. For traders, this volatility presents the chance to capitalize on rapid price movements, buying low and selling high to achieve substantial profits. Unlike traditional stock markets, the crypto market operates 24/7, providing continuous opportunities to trade at any hour, making it accessible to people in different time zones and with varying schedules. Another significant opportunity in cryptocurrency trading is the diverse range of assets available. Beyond well-known cryptocurrencies like Bitcoin and Ethereum, there are thousands of alternative coins, altcoins, with varying use cases and market potentials. This diversity allows traders to explore and invest in emerging technologies and niche markets within the crypto space. For instance, decentralized finance, DeFi, tokens and non-fungible tokens, NFTs, have opened new avenues for investment, each with its unique set of dynamics and growth prospects. Cryptocurrency trading also offers opportunities through leverage and margin trading provided by many exchanges. Leverage allows traders to control larger positions with a relatively small amount of capital, amplifying potential gains. However, it's important to note that while leverage can magnify profits, it also increases the risk of significant losses. For those with a high risk tolerance and a sound risk management strategy, leverage can be a powerful tool to enhance trading outcomes. Furthermore, the development of automated trading systems and bots has revolutionized cryptocurrency trading. These technologies enable traders to execute strategies more efficiently and capitalize on market opportunities with precision and speed that manual trading cannot match. By using algorithms and machine learning, traders can set predefined criteria for buying and selling, thereby minimizing emotional decisions and improving consistency. Lastly, the expanding regulatory landscape offers long-term opportunities for traders. As governments and financial institutions increasingly recognize and regulate cryptocurrencies, the market is expected to mature, leading to greater stability and wider acceptance. This evolution can attract institutional investors, increase market liquidity, and provide more structured trading environments, all of which can create more predictable and safer trading opportunities. Overall, cryptocurrency trading offers dynamic and varied opportunities, from capitalizing on market volatility and exploring diverse assets to leveraging advanced trading technologies and benefiting from a maturing regulatory environment. However, it's essential for traders to remain informed, adaptable, and cautious, as the crypto market is inherently risky and unpredictable. The Bitcoin market is playing its game. The world of Forex trading has seen a number of highly successful traders who have amassed substantial fortunes through their skills and strategies. Among these elite traders, George Soros is often cited as the richest and most famous Forex trader. Soros, a Hungarian-American billionaire, is renowned for his prowess in the financial markets and his daring speculative bets. George Soros's most notable achievement in Forex trading occurred in 1992, when he made a legendary trade that earned him the title, "The Man Who Broke the Bank of England." On September 16, 1992, a day now known as Black Wednesday, Soros's hedge fund, the Quantum Fund, bet heavily against the British pound. At the time, the United Kingdom was part of the European Exchange Rate Mechanism, ERM, which pegged the pound to the German mark. Soros believed the pound was overvalued and that economic conditions in the UK would force it out of the ERM. His massive short position on the pound, reportedly worth $10 billion, resulted in a profit of approximately $1 billion when the British government was forced to devalue the pound and exit the ERM. This single trade not only cemented Soros's reputation as a master Forex trader but also significantly increased his wealth. His success has been attributed to his deep understanding of economic fundamentals, his ability to anticipate market movements, and his willingness to take significant risks. Soros's approach to trading combines macroeconomic analysis with speculative strategies, enabling him to identify and exploit market inefficiencies. Beyond the Black Wednesday trade, Soros has continued to be an influential figure in the financial world. He has authored several books on investing and finance, sharing his insights and philosophies with a broader audience. Additionally, Soros is known for his philanthropic activities, having donated billions of dollars to various causes through his Open Society foundations. While George Soros is often highlighted as the richest Forex trader, other notable figures have also achieved remarkable success in Forex trading. These include Stanley Druckenmiller, who worked closely with Soros at the Quantum Fund and is known for his own impressive trading record, and Bill Lipschitz, who transformed a modest inheritance into a substantial fortune through strategic Forex trades. In summary, George Soros stands out as the richest and most famous Forex trader, primarily due to his audacious and highly profitable bet against the British pound in 1992. His success in Forex trading is a testament to his exceptional analytical skills, strategic foresight, and willingness to take calculated risks. Soros's legacy in the forex market continues to inspire and influence traders around the world. To new traders, I advise to start small. Begin with a small trading account and gradually increase your position sizes as you gain experience and confidence. Avoid big positions, as it can amplify both gains and losses.